Hi, it's Ed Moya here, Chief Currency Strategist and Head Forex Educator at Trading Advantage. Welcome back. I'm so glad you're watching this video. If you missed the first video where I taught my proprietary risk calculator, I encourage you to watch it. I really believe that proper risk management techniques can keep you in the game for the long haul. But risk management is only part of the equation. To be a successful Forex trader, I believe you must also incorporate fundamentals and technical analysis. This is what I do in my own trading and in my live signal classroom, where I teach you how to look at the market from multiple perspectives. In this video, I will give you a technical strategy that you can immediately apply to your trading. So let's get started learning a technical strategy that you can apply immediately to your Forex trading. It involves harmonics. And no, that's not listening to music to stimulate a meditative state while you trade. I will tell you about harmonic patterns and the specific ABCD pattern and its use for the bullish and bearish setups. I will teach you how to draw the ABCD pattern and help you incorporate it in our trading and how to spot strong risk-reward ratios. The ABCD pattern is a harmonic pattern that looks like a lightning bolt, and its purpose is to identify a potential reversal point. It's just like an indicator and should be used with other macro or technical indicators to confirm trading decisions. This pattern was first discovered by H.M. Gartley's book, Profits in the Stock Market. It became popular in the late 90s after Larry Pizzavento's extensive research and book Fibonacci Ratios with Pattern Recognition. Here you can see a picture of Larry and me working the Traders Expo in 2007 for GFT. Throughout my years of trading and testing various strategies, applying pattern recognition became a pivotal part of my trade analysis. When the stock market was crashing and the pundits were talking about the S&P falling to 500 and the Dow to 4,000, this type of analysis helped take away the emotion by defining specific entry points. The chart below highlights a bullish ABCD pattern at the... So why should we use the ABCD pattern? Well, one of the best reasons is that it helps take away emotion from trading by defining specific entry and exit points. It's also pretty straightforward. You will use specific Fibonacci levels to confirm each leg of the pattern. My favorite reason, though, is that it allows for aggressive risk-reward ratios. You'll find times when you might be risking a 1% move and trying to capture a 5% reversal. Lastly, while we normally find these patterns throughout all time periods, sometimes they fail, and that can be just as useful as it might confirm it. Here's an example of an ABCD pattern in use. Let's take a look at it in detail. You'll notice that we have a pretty strong downtrend in the euro, and the chart is highlighting three bullish reversal patterns. The first one in green, the second one in red, and the third one in blue. In this example, you'll see that the ABCD pattern would be extremely helpful in identifying when to exit on your bearish trades. With the ABCD pattern, you will not need to ask yourself these questions. Did the moving average cross over? Are we going to see an hourly close above this key level? Did the wick touch the upper band? What if 3 of the 4 shorter time frames are overbought? The daily chart's oversold. Should you still sell? These are all questions we've asked ourselves using various technical indicators for moving averages and various oscillators. The beauty of the ABCD pattern is that it has mainly a definitive set of rules that define each entry and exit on every trade. So how can you apply the ABCD pattern to your trading? First, you'll need to learn how to draw it, which I will now show you how to do. Step 1. First, you need to identify a significant high or low point. That should then be followed by a strong move that eventually stalls and reverses. Step 2. We will then draw a Fibonacci retracement from that significant point. We will also call that point A, and then we'll draw a retracement to point B. This retracement will target point C, which should fall at the 38.2, 50%, 61.8%, or the 78.6 Fibonacci level. Please note that the wick will just need to touch one of these levels. Now that you've found points A, B, and C, it's time to find your point D. So how do you do that? Before we move forward, please make sure to add the following expansion levels to your Fibonacci drawing tool: the 127.2% and the 161.8% expansion figures. We will then apply our Fibonacci drawing tool from point B to point C. Please note, you may need to redraw this multiple times because you may be identifying a new point C if price continues to have a deeper pullback. Once we identified a potential point D, we will also look at the symmetry of the pattern. The pattern may be stronger if the distance from A to B is identical to the distance from C to D. Lastly, You'll remember that I highlighted the ABCD pattern is a technical indicator, and you can combine it with other indicators to provide a confluence of where this potential reversal may take place. I like to also use significant resistance support levels and the 200 and 100-day simple moving average. Remember, we want to always employ proper risk management by using our risk calculator from the first video and finding beneficial times to trade. FX historically has been one of the strongest trending markets. We may find a strong trend that could last for 3 months, 1 year, or even longer. You should remember our first commandment, which is always to define your stop loss. The ABCD pattern will put you in a position where you can trade using aggressive risk-reward ratios such as 1 to 2, 1 to 3, or even higher. Remember, we may use the ABCD pattern in 2 ways. If our risk calculator tells us that a strong trend is seeing price trade with a lower average true range reading, we may have an ideal reversal pattern setup. If the market is range bound though, and our average true range is in the middle of that range, ABCD patterns could be more effective if they have confluence with key resistance and support levels from the upper and lower boundaries of the trading range. The bullish ABCDs may work best though on daily charts and 4-hour charts. On the macro side of the trade, ideally, we'll look for a bullish reversal on a weak currency that might have pessimism from a recent downgrade, or maybe they're heavily into a recession. In this example, you can see price action has confirmed point D with the 161.8 expansion level of the B to C move. Bearish ABCDs also work best with larger time periods. In this example, you'll notice that point D is also confirmed with the 161.8 expansion level of the B to C move. We also have added resistance from the 106 area, which is a key psychological level for Aussie dollar. Now that you can draw an ABCD pattern, and you've seen some examples of how it works, it's critical to learn where to place your stop loss. Stops on the daily or 4-hour charts should be placed anywhere from 30 to 50 pips away from point D. We want to make sure we give our trade the opportunity to suffer some drawdown, but not too much. If you're using shorter time periods, please also make sure you make your stops a little bit tighter. It's also recommended to use prior support and resistance levels or simple moving averages to help you with your stop placement. And please, if the pattern does fail, you may have a continuation pattern that could warrant a deeper continuation of the original A to B move. This is just one of the many strategies I teach in my Forex classroom. In my third video, I will give you a fundamental analysis tool that can be used when there is a global economic event. Let's face it, the world is unstable, and with the problems in Europe alone, there are ample opportunities to capitalize these currency fluctuations. You can't afford not to watch my third video and learn about the macroeconomic warning.